Good morning, ladies and gentlemen. Good morning, good morning, good morning, good morning. Today, we are going to explore five of the top strategies why millionaires and billionaires why they don't really pay taxes. We're going to let me cut that off. Okay. Somebody was already watching. Good morning, ladies and gentlemen. Good morning. Good morning. Good morning. Talking about why millionaires and billionaires don't pay any taxes. Okay, so today we're going to leverage. We're going to what the heck am I doing here? So today we're going to talk about the five top strategies that millionaires and billionaires leverage to avoid paying taxes at all. They pay taxes. They don't pay taxes. Why don't they pay taxes? I see a lot of disappointment when people say that billionaires and millionaires are not paying taxes. Personally, I really do not expect them to pay taxes. And I'm going to today, this morning, I'm going to give you five great reasons why these people should not and why you should not be paying taxes as well. Good morning, and thank you for making it to this very first edition of our Saturday morning webinars. My name is Charles Njoya. I'm a CPA, I'm a tax strategist, I'm a wealth coach. So we're glad to have heeded to your call to have these seminars on, to have these programs, these webinars on Saturdays rather than on Thursdays. The turnout looks impressive so far, but I think we can do better. So please start by liking, sharing the video so we can have a full audience today. You may want to follow us on YouTube, on Instagram, and on Facebook so that you are the first to be notified when any of our programs are on. I am especially delighted with the turnout today as we head to the tax season. We have some very exciting tips for you to make sure that you are taking advantage of the tax code and you are optimizing your taxes. Today, I have three different platforms. I'm on YouTube, I'm on Facebook, and I'm on Instagram. So if you see me not paying direction to your wherever you are, then just know that it's because I am paying attention to another platform. So one of the things I see that comes to me, I mean, we'll start by this CNN business magazine. CNN Business said, and I'm just going to quote directly from them. They said Elon Musk has a history of using the UX tax code to pay little or no taxes, to pay little or no federal income taxes. A report from ProPublica shows that for 2018, Musk and many other Americans near the top of the world's richest people paid zero in taxes. End of quote. Okay, it goes on to say that in Musk's case, he received no salary, I mean, zero salary from Tesla, only very valuable stock options as a form of compensation. And under the US tax code, he doesn't have to pay taxes on those options until he exercises them to buy shares of stock at a fraction of their current value. So, I'm just going to say here, let me just correct that article by saying that the mere exercise of stock options, does not trigger any taxable event until the underlying stocks themselves are sold. Okay. So Musk understands how to play this game, and he's been playing it to perfection for many, many years. So we're going to learn and see how we can use those strategies for our own advantage as well. So, based on this article, since the creation of Tesla, Musk has hardly paid any taxes from all his billions for many, many years. So, in this video, I'll explain how he did it and how you too can do it legally without breaking any rules. So, there are two main types of income. There is what you call the earned income, and there's what you call the unearned income. Earned income is income from work. It is income from the work you do by yourself, which is wages, salary, business income, self-employment income. All those are earned income because you worked for them. Then there is something called unearned income. Unearned income is from passive activity. Passive activity is anything that you don't actually engage in as an active form of work. So, passive activity, buying and selling of stocks, limited partnerships, real estate investments, dividends, interest income, all those are different types of unearned income. So, some of the billionaires have added a third category of income, which they call cash flow. Cash flow by itself is not an income. But since most billionaires and millionaires live off cash flow, they tend to call this a form of income. So let's talk about the three different types of income. We've talked about them. Earn income tax rates. So when you earn income, that's you're working from a job, your tax rates are among the highest income tax rates. So basically, your tax rates you're getting, the least is 10%, then you go 12%, you have 22%, you have 24%, you have 32%, you have 34%, and the top tax bracket is 37%. So when you earn anything over and above 200,000, you are already in the 37% tax bracket, and that's a high income tax bracket. So this is so when you earn income from work, you are in the highest tax bracket. So most investment income are taxed at capital gains tax rates. And capital gains are any passive activity form of income. So when you earn passive activity income, what you basically get, you get that income that is taxed at a very low income tax rate. Low income tax rate is 0%, 15%, and 20%. And most millionaires and billionaires, they are mostly engaged in passive activity. And where they make the most is they live off of cash flow. Cash flow is taxed at 0%. Now let's look at somebody you all know. Let's look at Trump. The Times newspaper obtained Donald Trump's taxes for extending over 2 decades. And what they said, I'm just going to read it. They said it revealed struggling properties, vast write-offs, an audit battle, and hundreds of millions in debt that was coming due. Note the word over more than 2 decades. He had struggling properties. He had vast write-offs. He had an audit battle, and he had hundreds of millions in debt coming due. All those are tax strategies. We're going to talk about them. Then Donald Trump paid $750, not 750,000, but $750 in federal income taxes for the year he won the presidency. And in the first year in office, he paid another $750. He had paid no income taxes at all in the previous 10 to 15 years, largely because he reported losses for more than half a decade. For more than that decade, he reported large losses. So this is directly read from the New York Times. So when Trump was asked about this. He was asked about this on Visual Mundo during the debate. He said that was because he's smart. And most people laughed about it. Most people were angry about it. But I agreed with him 100%. And the reason I did so, we're going to explain in further detail. So, in fact, I believe very strongly that if you are a real estate professional, which I believe Donald Trump is, and you are operating at the level he does, then you should not be paying a dime in taxes for the reasons I'm going to enumerate below. Another billionaire, which you all know, let me take Warren Buffett. He's been quoted so many times as saying that his secretary pays far more in taxes than he does. So Forbes magazine, on Forbes website for 2021, I went there just to see some of the things that were written there. And one of the things I saw there is that it says clearly that the richest Americans, including Jeff Bezos, including Elon Musk and Warren Buffett, they paid federal income taxes equaling 3.4% of the $401 billion in new wealth that they created in 2021. 3.4%. This is, and I know that this amount was mostly made up of what came from an outlier, which is what Elon Musk paid in 2021. So Elon Musk paid $11 billion in taxes in 2021. And that was after many, many years of paying zero. And he actually touted all of us and said, okay, maybe I should pay some taxes. And that is when he decided personally that he was going to pay some taxes. And he paid 11 billion. And for many, many months, for those who are following Elon Musk, you know, he's consistently been saying that he's paid more taxes than anybody. That's true. But he decided he was going to pay that money. And that is when that's when he became the richest person on earth with more than 200 and I think it was $250 billion worth of net worth. Now, let's see why these people do that. So why do these millionaires pay no taxes? And can I do it too? The answer is absolutely yes. You can do it as well. The first thing that these people do that allows them to be able to avoid these taxes is they leverage debt. Debt is one of the things that most billionaires and millionaires and any person who is savvy in taxes plays on with. So you do not pay taxes on debt. Rich people focus on growing assets. They grow assets. They invest in capital expenditure. So they can use that to leverage debt and have access to cash flow. Rather than take a salary or income that will be taxable, they rather grow their assets, which give them unlimited access to other people's money. So you grow your assets and then you have access to other people's money. For many years, Elon Musk did not take a salary in Tesla. He accumulated share options that he used to access debt and continuously invests and lived on. So let's get to number two. So number one is leveraging debt. Debt doesn't pay any income. So when you live on debt, you don't pay taxes. The second thing is investing long term. Long term is such an important thing when you are thinking building wealth. They invest long term and focus on growing the basis of their assets, real estate, stocks, and do not sell. They invest in all these things and they do not sell. Hence, they are not carrying taxable. They don't create taxable events. When you don't take an income in the year, when you don't get an income, when you don't have earned income, you don't have any taxable event. As long as you focus on increasing the basis of an investment, and so you do not sell or take out income from that investment, There is no taxable event. So, yet you are growing your wealth. You keep growing wealth by investing, by building those assets, by reinvesting in those assets. You're building wealth, and there's no taxable event until you actually take an income out of there. So these guys, they are long termists. They don't concentrate on short-term activity in a way as to develop and to create income during the period which is taxable. The focus here is on wealth and not income generation. They focus on increasing their basis in those assets. They are not focused on increasing on income. Most CEOs, most employees, you see, there are some top CEOs out there who earn $50 million in tax in income. They earn 50 million in a year. But when you earn 50 million in a year, if you don't invest it widely, if you don't have a proper person to help you optimize that money, you're going to pay more than 50% of that money in taxes. Number 3, which is very, very important, is cost segregation studies. So, as long as you are a real estate professional, you can use passive activity losses to write off ordinary income. So, you must first of all qualify as a real estate professional, and there are things that you have to do in order to qualify as a real estate professional. And once you qualify as a real estate professional, you have access to what you call you have the ability to take passive activity losses and write off your ordinary income worth. So the likes of Trump, who are real estate operators, they can take advantage of some of these cost segregation tools, and they understand them so well. Cost segregation studies, many people talk about it. I don't know if many people talk about it, but many people who even understand it, there's a whole process to cost segregation, and you can do it. All of you who are in, maybe you have Airbnbs or you have real estate, you are investing in real estate. Real estate is one of the biggest vehicles of avoiding taxes, of tax avoidance. Yet you make a lot of tax losses. While making money, you're making a lot of ordinary income, of ordinary activity income. Cash flow is generated, but you're making a lot of tax losses in real estate. And that is where these people keep their money. This is the biggest benefit in real estate. It allows you to recover costs a lot quicker and on certain portions of the real estate activity. So in most cases, rather than depreciate your real estate activity over 39 years or over 27 years, there is something called commercial real estate. Commercial real estate, you depreciate commercial real estate over 39 years. And then if you are in personal property, if you are in rental property, if you're doing rental property, what they call residential real estate. If you are in residential real estate, it takes you, how much do you pay? It's 27 and a half years of depreciation. And apart from those depreciation, when you do cost segregation, you basically can break components of that particular asset, of that particular real estate property. When you have a rental property, you have refrigerators, you have the roofing, you have different parts of different cabinets, you have all sorts of different components of that asset that you can break out, and then you are able to depreciate on a shorter basis. You are able to take some to accelerate some and even take bonus depreciation on them, depreciation over 3 years. So it creates a lot of what you call taxable losses that you can either write off now against your ordinary activity, or you can carry forward for many years. And as long as you're making ordinary income on other activity, you can take those losses and write them off. That's what you call net operating losses. So let's look at another one. Number 4 is bonus depreciation. So other bonus depreciation, we think about section 179. We just talked about cost segregation, which allows you to be able to do to accelerate some of those items that are there. These are other depreciation. Other depreciation you can take, which rich people, which billionaires and millionaires take, is they take Section 179, they take bonus depreciation, which means you can just buy a huge equipment. And then instead of depreciating that equipment over a long period of time, you're allowed to depreciate to take a full write-off immediately. You're allowed to take a full write-off. You made $1 million, and then you went out there and bought equipment for your business worth $1 million, which you are not even buying out of the cash in your pocket. You're using other people's money to access it. You bought that equipment for $1 million, and the IRS tells you that you didn't spend a dime. You acquired an asset to build your business. The IRS tells you, guy, you can take that write-off as long as you are, it's an operating activity. You can take that write-off and write it off against that $1 million that you made, and then you are on zero tax. Zero. So another one, which is most important, you also have to leverage. What these people do, they hire the services of the best people to work for them. They make use of services of tax strategists to help them take full advantage of the tax code. What I tell people is that the tax code in itself, the tax code, most people think that it is there to penalize people. The tax code is actually there to help people avoid taxes. It is there. It has every little bit of a tax benefit or tax incentive that is out there for you to go and use, exploit, and then you are able to invest in those areas that the government, the politics of the moment wants you to invest in certain activities, and they give you a lot of incentives in order to do that. So these people, they just take advantage of these. They use the right people who understand these tools, and they can help them avoid these taxes. They will hire the best CPAs, tax CPAs. They will hire the best tax attorneys. They will hire people who are tax strategists, who understand the details of the tax law, who can take these tax laws and help them avoid these taxes. This tax strategy is something that you do throughout the year. Most people think that they come to you at the end of the year and they just say, Charles, help me. I already have a lot in taxes. How can we do this? When you want to build wealth by avoiding taxes, what you do, number one, is that you hire the services of the tax strategist. And you start from day one by planning how you are going to avoid taxes, especially for those of you who are making a lot of money out there. I saw a lot of people, a lot of nurses who made a lot of money during the pandemic. Some of them made close to $1 million, and they come to you at the last moment and tell you, okay, I made a lot of money. How do I avoid taxes? You really cannot avoid taxes at that point. Why? Because you can only do as much. You can't do it very much. You come to the taxpayer when you are planning on something. You start at the beginning of the year, and that is what they do. They work with the best tax people, and then you work with them on a sustainable and consistent basis to help you avoid taxes. So I just gave you 5 strategies out there. If you take those 5 strategies and put them, and one thing I want to tell you people is that you don't want to. This is the beginning of a new year. At the beginning of a new year, what you want to do is to connect with the best people, start planning your strategy. And strategies to build wealth doesn't start by just coming at the last day. You start by discussing these things. They will tell you where you can invest to avoid taxes. They will tell you where you can put your money in order to optimize your taxes. They will tell you where you can defer some of your taxes. I mean, I have a paper that I wrote that is online. It's available. I gave more than 20 different tax strategies that individuals can use at any point in time. So we have all these strategies. You just need to be able to start planning against them, making them happen for you. I can give you more than 50 strategies that you can use, but they all depend on each individual situation. I salute you, Amy. I salute you, Ben. I salute Aurelie, who is online. I salute all of you who are online. I greet you. I mean, I'm just online. It's a late hour for me, and I just thought maybe I just come online and say a word about these things. These are things that are critical. We are in the beginning of a tax season. And when the tax season comes, it's more about just implementing what you have already planned. If you didn't plan well, you can already look at what you've done this year and then reorganize yourself for next year. Our goal in this country is to make it happen. And for us to make it happen, we cannot come with our vessels from back home, from wherever we are coming from, and then we don't really try to understand how this system works. This system, there is so much you can do. I just gave you the first tax strategy I talked about that was using other people's money. It is incredible. The access to wealth can only go by building a capital base. It only goes by building your basis. You build basis and then you avoid taking income. You build basis with other people's money. There are two types of incomes. There are two types uh, of debt. There is something that you call consumption debt. You take it, you buy a car. You take it, you buy your clothes, you buy your perfume, you buy this, you buy that. And then that is called consumption. It is all gone. It is an expenditure. But there's also something you call capital expenditure. So you take a debt and then you invest in something. That something is going to build cash flow. And that same cash flow that you build from that thing, what is it going to do? That is, you live off of that cash flow. You live off of cash flow, which is coming from a third party because you have a strong asset base that you can leverage to access other people's money. I keep telling people all the time that there are two things that will give you access to wealth in this country. They will give you access to other people's money. Number one is your tax return. Your tax return is the most strategic tool that you have. And if you prepare your tax return on the basis of, okay, I just want to prepare this tax return for compliance purposes, you are going to completely miss out on the game. The game is your tax return is a strategic tool. The worst thing you want to do on your tax return is to not report your income. There are so many ways you can leverage and you can have the best refund on a tax return without necessarily evading taxes, because the tax laws of the United States tells you that you pay taxes on your worldwide income. And for me, I will never tell anybody, guy, do not report an income, because it's just like I am being penny wise and pound foolish. When you report income, that is, you're showing everybody that you have ability to pay. Ability to pay is demonstrated on your tax return. That is why when you go to buy a property, when you go to buy any of these things, they will ask you, can you show me a couple of years of your tax return? The reason they are asking for your tax return is because they want to see something. And the question you should be asking yourself is, what is in this tax return that these people want to see so badly that will determine the amount of money I can get access to? So if that thing is allowing me to only get $500,000 now to acquire this home, what can I do to make sure that I get, the next time I come, I get $1,000,000 or I get $2,000,000? So you have to enhance it. And the ability to pay is shown on your tax return. So that is number one. You prepare your tax return as a strategic document towards your intent, towards your strategic intent. Where do you want to go? I want to build wealth. I want to do this. I want to build real estate. I want to do this. I want to have a business. You don't build a business out of the cash that you make from income. The cash that you made from income is not going to help you build wealth. What is going to help you build wealth is taking advantage of the largest capital market in the world, which is the United States. If you came to the United States, you want to take advantage of the only single thing that they have that every other country doesn't have. So why would you throw that into the gutter? Because you're looking for, maybe someone told you that, okay, if you did this, you are going to pay more in taxes. So you are trying to avoid that. Instead of getting the right person to tell you the right things to do, you're doing it with the wrong people. So basically what I'm telling you is that, number one, your tax return is the most important thing that gives you access to capital. So your ability to pay is demonstrated in your tax return. Number two, when you have the ability to pay, the banker, the financial, the institution, the capital market, what they are looking for, the second thing that they are looking for is your willingness to pay. Willingness to pay is demonstrated by one thing. There is something called your credit score. Your credit score is the accumulation of of your having shown that willingness to pay over time. So you have paid, you've shown in the past that you are paying your debts. So when you come to a banker, the banker only has one thing in mind. He wants to give out more loans because that's the way he's going to make money. He wants to give out more loans because he only gets money by selling money. So he gives out more loans and he gets interest. He has no reason to deny giving you a loan unless you have denied yourself through incorrect tax returns, and then secondly, not showing your ability to pay. So we all are in the position to build those two tools. They are very, very easy things to build. If you can show a banker, if you can show the financial institution, if you can show the capital market that you made $100,000 last year, you have access to at least $500,000 to $500,000 in other people's money, as long as you're investing in the right things. So why are we not doing that? So if you can enhance it and show somebody that you made $300,000, you have access to more than $1.5 million. Why can we not doing that? Why can't we show these things and then get access to those things that will help us build our businesses? And then there is something I tell people all the time. There are four quadrants of tax, four tax quadrants, four main tax quadrants. The number one tax quadrant is the employee. So the employee in the United States, when you are an employee in the United States, you pay taxes and especially when you're a high earning employee, because if you look at taxes, most of the people who pay the taxes are the employees. When you are an employee, your tax bracket, if you're a high income earner, you're paying up to 37% of that money in taxes. And then, in addition to that, if you're in a state where they pay state taxes, you're going to pay an additional maybe 10-15% for the state taxes. And then there is something that so just those two, they're taking you to over 50% of your taxes if you are the higher income tax bracket. And most of us, we are aiming to be in the higher income tax bracket. So when you are there, which is the place where you pay the most in taxes and you don't even have control over it. So what you quickly do, you want to run away from that place where you call it the employee quadrant. You move from the employee quadrant and then you go down very quickly into the entrepreneur quadrant. You are the entrepreneur. You are the solopreneur. You're trying to build a business. So you're moving, you're trying to build a business. You've just created your LLC and all whatnot you're trying to build. When you are in that category where you have a small business, it's what you call informal business. Because in America, you can register. Even when you register, it's still formal. But you can, as long as you are not strategic, you are not structured properly, you're still in that informal situation. When you are an informal tax preparer, when you are an informal business person, you have something that is called, you are self-employed. So basically you move from employee to self-employed. When you are self-employed, there is an additional tax, which is a crazy tax. In addition to whatever taxes you were paying, you pay something called self-employment tax, which is an additional 15.3%. So basically, when you move from employee and you start a business very quickly, if you don't seek the services of a tax planner, of a tax strategist, of someone who understands the tax law, you are going to find yourself that you have messed yourself up when it comes to taxes, because the taxes become crazy. And that's why in my tax resolution business, most of the people that we see that are having problems with, the IRS, they are owing $500,000, $700,000, $1 million from IRS, are people who started doing a business. They were never structured, and then they had all these crazy, they're filing a Schedule C for a business that's making $7, $8, and $10 million. So these guys, you fall into that situation and you're just paying crazy. So you want to run very quickly from that place where you call yourself self-employed, and then you create a business, which is a formal business. You own a business, a corporation. When you own a corporation, either an S corp or not even not a pass-through, but you own a corporation. When you own a corporation, the tax rate went down to 21%. They went down to 21%. So you just left all those crazy taxes and you went to 21%. And this 21% is after you've taken down all the possible write-offs that are available to you. You take out those, and then you are only paying that 21% on your net. After you've paid yourself, you've paid your family, you've paid everybody who's working, you've paid your husband, all those things, you've paid all those things. Then you take the net. Now you're paying 21% on that net. Then the last place where most of these millionaires are is what you call, they are in that bracket where you call them they are in that position that you call uh, uh, investors. When you are an investor, you are in the El Dorado of taxes. When you are an investor, you pay very little in taxes. Your taxes are almost 0%. And most of these are billionaires and millionaires. They're in that category. Because why do you pay that? Most of your things, you don't live on income. You are paying people who are the ones paying all the taxes. When people kept saying that, oh, Donald Trump, you don't pay taxes, he says, I pay taxes, because he has thousands of people working for him. And those thousands of people are the ones paying taxes. He paid some 941s. He pays 941s on those people who are paying taxes. And that's it. He's paying taxes. He's helping people to have jobs. He's investing, but he's not taking money out. When they asked him, when he went to the presidency, he said he didn't even want to get an income from the presidency. There's always a strategy behind everything these people are doing. I don't want to take an income. So you don't want to take an income because that income is going to make me pay taxes. I really don't want it. I need to get my asset base to be growing. Then I have access to other people's money and I live on it. So these are some of the tips that we can keep saying and giving them over and over and over. So, guys, I want to thank you. It's late in the morning. Let's go to bed. I just want to thank you for being here today, and we will have much more time to talk about these things. You have an excellent rest of your day. Bye bye.